Look, in old money that you and I grew up with, inflation's at 7%, 7.1% in RPI as well. New money, there's potential and expectations we're going to get to 6%. I appreciate the Bank of England's gone on it and gone for up 0.15 of 1%. But if that old and new money continues to be persistent, we've got a lot more rate hikes to come, haven't we, sir?
Well, I think that's true. I mean, what we saw yesterday was the bank's response to a view which has been building through time, accumulating evidence that underlying more domestically generated inflation here in the UK, probably centered around cost and wage pressures in a tight and tightening labour market, are going to prove more persistent through time. And in order to ensure the credibility of our objective, our inflation target, going back to 2%, we collectively felt that it was the time had come to act, to take away some of the emergency support for the economy that was introduced 18 months ago at the time of the outbreak and initial onset of the COVID pandemic. The time had come to take away some of those emergency settings, begin to withdraw monetary accommodation in order to signal that we have a commitment to meeting our inflation target, and that the pressures we see building domestically within the labour market, in services, prices, inflation, and so forth, need to be addressed by somewhat tighter policy and a somewhat higher bank rate.
Are we behind the curve, though, Hugh? I obviously spend a lot of time in the city, like you, but I also spend a lot of time in the real world. And I don't know one company, from the biggest consultancies, the richest Deloittes of this world, to the builders I know, to everybody who doesn't have some form of labour shortage or doesn't have some form of wage increase baked in order so they don't have a labour shortage as well. The real world says to me that the labour problems that you're alluding to, they're here, clear and present now already. And that's in a world that had, hopefully, got rid of COVID as a major factor, and now it's come back again.
Well, I think you make 2 points. I mean, the first thing I'd say is we signalled, collectively quite strongly back in November that we were steering towards having a rate increase precisely because of that build-up of inflationary pressures and tightness within the UK labour market. We were concerned that the end of the furlough scheme, which took place at the end of September, we needed more data to really be able to assess whether that still relatively large number of jobs that were furloughed as the scheme came to an end, whether the end of the scheme would release workers into the labour market and lead to some easing of that tightness. I think the data that we've seen over the last 6 weeks or so has confirmed that, in fact, the labour market is tight, as you say. It's tighter even than we expected at the time we published our November forecast. And Omicron notwithstanding, there are reasons to expect it to tighten further. So it's on that accumulation of evidence and that confirmation after the end of the furlough scheme that this tightness is there, that we have embarked on this withdrawal of accommodation yesterday. Omicron has introduced a new level of uncertainty into our assessment of the economy as a whole, the inflation outlook and labour market developments. And I think we need to move forward now cautiously, in the sense that we need to assess whether Omicron is going to lead to some reversal of the strength of the dynamics in the economy, and particularly in the labour market, that we've seen over the last 6 months plus that you referred to. But I think it's also important to keep in mind that that Omicron-related uncertainty is probably two-sided, at least as it is reflected in our core objective, our ambition in terms of the inflation outlook over the medium term. So, we have some homework to do in both seeing how the Omicron variant impacts both public health and the developments in the UK economy, but crucially interpreting how those things influence what has to be the thing that we focus on and the thing that we can best influence, which is the medium-term inflation outlook.
Hugh, to what extent have we seen an altering of behaviours. I mean, we typically talk about economic growth and demand around the pandemic. We've been talking about when restrictions come into force and we see this change in consumer behaviours, and the demand story, of course, falters. But this time round, we've seen a lot of different headlines where people are censoring their own behaviour. You know, coming into Christmas, they are concerned about catching COVID, also whether they can see their loved ones at this point, and just not taking themselves out to the usual social venues that they may have at this time of year. So is it a new phase as you sort of crystal ball into the future, because people are altering their own behaviours now, not waiting for governments to tell them what to do?
Well, I think this is not the first time we've seen changes in household behaviour and firm behaviour, even in the absence of formal restrictions imposed by the government. And I think there's some evidence from the outbreak of the pandemic that the restrictions followed rather than led some of the changes in behaviour. I mean, I think the point you make is right. We do see evidence of some slowdown in certain types of activity, notably in the consumer-facing services sector, catering and hospitality and so forth. And that's evidence that we need to monitor closely. I think, though, it's also important to keep in mind that the experience of the last 18 months, both globally and here in the UK, has been that these changes in household and consumer behaviour, they also affect the pattern of consumer spending as well as the overall evolution of consumer spending. And it's part of the reason we have faced these inflationary pressures stemming from so-called supply bottlenecks has come from the fact that we've seen a substitution of what might previously been spent in consumer-facing services like hospitality towards spending on household durable goods and so forth. And those household durable goods, many of which are imported or at the end point of international supply chains that have themselves been disrupted, it's that combination of heightened demand for household durables and disrupted supply to household durables that has been one of the features of the inflation process that we've seen. So again, Omicron may weigh on activity in the short term and particularly weigh on activity in certain sectors, as you've identified. But I think we need to be cautious in saying, just because it's weighing on activity, we assume that it's going to induce disinflationary dynamics over the medium term. And just to emphasize, it's that inflationary prospects over the medium term that we, given our remit and given our mandate, those are the things that we have to focus on most. So I think there's genuine uncertainty, despite the threat to public health, which obviously is very worrying, and the threat to short-term economic activity, which is clearly a concern of ours. I think nonetheless, there's genuine uncertainty and two-sided uncertainty around what the implications are for inflation at that longer-term horizon that we focus on.